Hello, it's Rhonda Thomas, and we're just about to do Managerial Accounting's Chapter 10, Introduction and Basic Exercises. So let's go ahead and share my screen here. Okay, so we have, let me get into it here. Chapter 10's basic, here we go. Preview as a student. Okay, so I do have the ebook open. Okay, this chapter, just a second, I'm getting my real book out. Can follow along a little bit better. Evaluating, okay, no, we evaluated variances with standard costs in chapter 9. Now we're going on into evaluating decentralized operations. Okay, decentralized operations. Let's talk about what that is. Okay, so here is the ebook. So a centralized company, all major planning and operating decisions are made by the top management. Okay, this is like having a headquarters, and any location that falls under the headquarters is directed by the headquarters. Well, sometimes it's not very easy to make decisions or the best decisions about something unless you're there at the local level. All right, so they have something called decentralized company, where managers of separate divisions or units are delegated operating responsibility. So the division unit managers are responsible for planning and controlling the operations of their divisions. Divisions are often structured around products, customers, or regions. Okay. And a lot of companies go back and forth a little bit with how centralized they are, how decentralized they are. It just depends on the company and the issues that they have, okay? But having said that, there are advantages of decentralization, because sometimes it's hard for top management to really know, especially if they're not in that location, to really know what's best, okay? So, maintaining daily contact with all operations and maintaining operating expertise in all product lines and services. So that is an advantage of decentralization, okay? But there are some disadvantages, okay? Sometimes you can have a lot of competition between divisions, which can sometimes not make for a lot of collaboration, right? So one division against another, so forth and so on. And there are a couple of different ways that we can decentralize. So the first one is, let's figure out responsibility. So responsibility accounting is the process of measuring and reporting operating data by responsibility center. So the 3 types of responsibility centers that we're going to look at in this chapter are cost centers, profit centers, and investment centers. Notice as we go down the list, there's more and more responsibility. So cost centers, they're responsible for the costs. Profit centers are responsible for both revenues and costs. And then the investment centers have the most responsibility: revenues, costs, and investments. Okay, so let's just keep that in mind. Okay, so a cost center, we're going to identify what it is, and then we're going to go work a couple of problems, or work one problem that talks about a cost center. So a cost center manager has responsibility for controlling costs. Cost centers may vary in size from a small department to an entire manufacturing plant. In addition, cost centers may exist within other cost centers. So they're giving you an example here of that. But what I want to show you is, for example, this is a budget, right? So budgets are the main analysis that cost centers use, okay? They plan for costs and then they see what the actual costs were. You were either over budget or under budget. And you know that over budget, right, in a cost center means that you spent too much. You spent too much. Over budget means you're spending too much. Under budget means you spent less than estimated. So spending less is how you increase profit. Okay, now they're not in charge of the profit, but they're in charge of trying to control costs to the best of their ability. So here's a couple pieces from a budget, right? So these are budget reports, and those reports will say whether something is over or under. Over or under. So we're going to use that example here as we get into this first problem. Okay, so let's do administration. Okay, and then we're going to have an administration tends to be the total. Okay, tends to be the total. Nope, we're just going to go with total. All right, total company. I know I've got some information up above, but I want to try to put it in the way that the book does. Okay, and now we're going to look at two divisions, a north and a south division. Okay, a north and a south. And when you look at both of these, they should add up to the total. Okay, so we're going to go, and then we're going to have to decide whether we're over or under, right? Over or under. So we will take actuals. Remember, we have been using actuals on the farthest left and budget. Okay. And then over budget in cost means you spent too much. Or you spent beyond okay, so spending too much is unfavorable, right? And if you have a positive number, that means, right? Let's just put this here. So if you have a positive number when you do this math, when you take actuals and subtract budget, you're either going to be over or under. Okay, so it doesn't matter either way, but it helps you tell a story of what's going on. So I'm going to put this in here a little bit different than I did when we did this in class. So this one's going to be over. And it's going to be spent too much. It's also going to be a positive number, right? So a positive number over budget is a positive number. And okay, and then it's going to be a positive number, but it's unfavorable, right? Unfavorable, spent too much. Okay, so just to help you remember, and once again, you have to know whether you're looking at costs or whether you're looking at revenue and profit. So once again, these are costs, and we want to keep costs as low as possible. Keep costs as low and under control as possible. Okay, because that is how a cost center can help with revenue. So if it's a positive number when we do this subtraction, it's over budget, it's unfavorable, means we spent too much. Okay, just to help you remember. Okay, but over here, this is under budget. which is a negative number. This is actually favorable. So spent less than estimate. Okay, so just to keep you going with what these mean. Okay, so now let's go to the problem. All right, so let's see here. This is a cost center. All right, so we're going to compare a budget at a cost center. The Swanee company's costs are over budget by $19,800. So over budget is a positive number, right? $19,800. Okay, so that's going to exist here in this table. And we want all of these to be numbers. Okay, so there's the over budget for the total company, but that's made up of an amount from the North Division and an amount from the South Division. So our total over budget, one more time, is, so let me type this in. Okay, so one more time, it's over budget. So we spent $19,800 more than we should have in the total company. So before you start going to the North and the South Division, we have a report that says that the North's region was under budget by 2,200. Okay, so under budget is favorable, but it's going to be a negative number. Okay, and when you compare these two together, oops, excuse me, we are equals, oops. Okay. Just a minute here. So put that in as a negative. Okay, okay, we don't want to subtract, we want to add back. Okay, we want to add back, so that's okay. Because this is over budget, so this is thought of as a this is thought of as a over budget amount, which is supposed to be that it's unfavorable spending. It's $19,800 beyond what we planned the budget to be. But the North region has $2,200. Okay, and if you were to, but this one's under budget. Okay, this one's under budget. So the North is under budget. So over here, $2,200. Okay, so what is the South doing? If you have 19,800 as an unfavorable and 2,200 as a favorable, okay, these two are supposed to add up to this. Okay, so if South, and we're supposed to solve for the South. Okay, solve for the South. So you would add these two back. Okay, and it looks like we get our South Division as being $22,000 over budget. So it's really the South is the biggest problem because the North actually has favorable results. So one more time, favorable, unfavorable, and unfavorable. The problem with that is this unfavorable represents both of these, right? So it's not unfavorable for both. It's only unfavorable for one. Okay. Excuse me. All right. So the amount is, we want to Because once again, these two numbers are supposed to add up to this. So what does it take? So we're going to solve for this number here. What does it take to add to the north so that we end up with a positive number of 19,800? Oh, excuse me. So we're going to add these together. Yep. So let me see here. I think this is the wrong direction. Yes, it is. So let's try this again. So we want to take the total, and subtract this amount, okay? And when you subtract here, this is already a negative number. So a negative number and a negative number is a positive number. So the south is 22,000. Okay, 22,000. Once again, this is a positive number. This is a negative number. Okay, so if you put that in as negative, then if you add these two, and once again, okay, we want to actually, because we want this to be a larger unfavorable, because the North's favorable got caught in the net of this, okay? Yeah. So we want to make sure to subtract this negative, leaving us with 22,000. Yep. Okay. Okay. So let's get this out of here. Whoop. Just a minute. Okay. Hang on just a second. We'll try this again. Okay. All right. So once again, these two numbers are supposed to add up to this. So if you take, okay, if you take 22,000, that's the biggest unfavorable, and subtract the favorable 2,200, you're still left with an unfavorable of 19,800. So, okay, all right, so that should clear us up there, I think. Okay, whoop. Boy, all right. It does not like me. Does not like me. Let's start over one more time. Okay, something, right? So this minus this equals this. All right, so equals this minus, and because it's a negative number, it turns it back into a larger number. So there you have it. 22,000. Okay, you just have to kind of, sometimes you have to draw yourself a picture. So if you put over budget in, and when we spend too much, right, as a positive number, and you put in when we don't spend too much, we spend less than we thought, which is actually favorable. All right. You just have to kind of help yourself think about what you're looking at and how. All right, let's move on. Okay, the next one is there are some departments that, and we've done a little bit of this before, okay, a little bit before, but we have what's called, we have to take a department, okay, and maybe it's a cost center, right? We have to take a cost center and allocate, here it is, support department allocations. Okay, so here are some examples of support departments. Okay, support departments and so on. So support departments allocations are indirect expenses to a profit center. So a profit center then, so this is going to have to do with a profit center. Profit center has the responsibility and authority for making decisions that affect revenues and costs, and thus the profits. Okay, so that's a little more than a cost center. Responsibility accounting for profit centers focus on reporting revenues, expenses, and operating income. Thus, responsibility accounting reports for profit centers take the form of income statements, okay? All right, this next one is we're gonna have a support department that has that needs to be allocated. So it says the centralized data analytics department of Drew Link Company has expenses of $103,500. So I put that down. Data and analytics department, departmental expenses. Okay. So data analytics is a support department, and its costs need to be allocated out to however many departments they work with. All right. So here is expenses, $103,500. The data analytics department spent a total of 6,900 hours for the period of time they're looking at. So we have a retail division and a commercial division. So there's the retail and there is the commercial. And before we go any further, we need a department expense rate of this data analytics. Okay, so it turns out the data analytics is $15 per hour that they help or they assist these departments. You say, how'd you get that? You take 103,500 and divide by the total number of hours for the period that goes to both retail and commercial. All right, and then they gave us, with these hours here, we were able to figure a rate. This is department expense rate. So this, I'm gonna put this down. This is data analytics service hour rate. So every time they go help somewhere, they need to keep track of the hours that they recorded. All right. So if you add up 3105 and 3795, which is department, retail division and commercial division. So if you add up those two, it should come to the service hours that they were talking about. Okay, so let's get rid of those. Okay, and then I want to add these together if you want to, just to double check that that number is correct. So I got 3105 plus 3795. Those are the hours, data analytics service hours. Okay, so we have to figure out how to allocate expenses for this data analytics department over two other departments. And we're going to do that by using the number of hours that they worked. Okay, and that's right. Put this in. Okay. All right. So we've already figured the $15 an hour. So we're going to take that 3105 service hours for the retail division and 3795 of the commercial division. They both get multiplied by 15. Here is their costs for each of their departments for spreading out this expense between the two. All right, so 46,575 and 103. And 56,925. Now, I accidentally did not include this one as the green. When you're finished, just to make sure you did fine, go back and add the two amounts together that you plan on putting to each division. So that should add up to the amount we're trying to spread out, right? And is it right? Yes. Okay, it is right. Okay, let's go to number 3. Number 3 is going to analyze a profit center. okay, a profit center. So here's an example of an income statement for two different divisions. Now, this one does not have cost of goods sold, and it does not have the profit margin and everything. It goes right to operating expenses, okay, right to there. All right, and so we're just following along, but we have information that's a little bit different. So I'm going to start at the top with sales. Then I'm going to go to cost of goods sold, and then I'm going to go to the gross profit. Okay, and then we're going to subtract the selling expenses. Okay, and then the department allocations. Okay, operating income is at the bottom. Okay, just a second. Here it is. We have a subtotal in here that we're not used to seeing. So sales, cost of goods sold, gross profit, selling expenses, operating income before support department allocations go in. So I got to put 2 in here, and I think, right? And so now when we're finished, now we can spread out those allocations. Okay, so we're going to go through these. You just put in what the sales is, right? Just what they say, 2,550,000 for the retail division and 1,700,000 for the commercial division. Cost of goods sold. Now this doesn't have cost of goods sold, but this one does. So we're gonna go with what we have. Okay, and I am putting in negatives here. Okay, and then we have a gross profit. Gross profit, 1,100,000. Okay, and then 950,000. And you can see me do this right here. Okay, so that's going to be my work paper for this. Then the selling expenses, you're putting those in. So selling expenses are $230,000 and 170,000. Okay, now we have our second subtotal. Okay, the second subtotal, 870,000. Okay, and then 780,000. And the service department allocation. Now, we have to do pretty much what we did up here, right here. Okay, so now we're going to take data analytics. My data analytics has a total of 340,000. They did 8,000 service hours for each company. Okay, and as far as we understand, it's just covering these two. All right, so we're going to find a rate. What's their overhead rate? Okay, the overhead rate is $42.50. Okay, $42.50. All right, so the total hours that they worked, the data analytics is 8,000. So they're dividing up 8,000. 2,000 is going to go to sales and 6,000 is going to go to commercial. So we just put all this stuff in until we get here. And then we take the number of hours times the rate. Okay, so we're going to subtract $85,000 of the service department allocation. And then the other side will be something similar. So we take 6,000 hours and take it times 42.50, and we get an allocation here, right? Allocation of 255,000. Okay, 255,000. And I put that in as a negative. Okay, and then the last one is our old operating income. Now we can subtract. So 785. Okay, and 525. Oop. 525. Okay, so we're going to check it now. Uh-oh, I missed one. So I didn't put enough in here, I don't think. Let's give it a try. Uh-oh. 700, oh, one too many zeros. That's okay. Okay, and then another one. I had way too many zeros. There we go. 785,000 is what we want. Watch your zeros. Okay, there are some profit margin, investment turnover, and ROI. Okay, these are different measures of or analysis to use for an analysis purpose. We have profit margin, investment turnover, and ROI, return on investment. Okay, whoops. So we're going to do all three of these, and I've got some formulas here. Okay, so a profit margin. What is the formula for a profit margin? Now, a profit margin is a percentage. Okay, profit margin is operating income divided by sales. So here's what it is, and here's how you find it. Okay, here's the variable, and here's how you find that variable. So for our profit margin, I'm going to put everything in here. I got $29,904 in operating income. I've got 267,000 in investing assets, and then I have sales of 427,200. Okay, so my profit margin, when I do the math, and here is the calculation, I take the 29,904 divided by the sales. Be careful, I missed a 2 there. Yeah. Okay, so 7%. 7% is my profit margin. So just put it in, and they want it to 2 decimal places. So we're going to put it in as they request. The investment turnover, however, is just a number. So the investment turnover is, and I can be happy to put this in. So investment turnover, let's just see. Turnover means that you've used up something already, or yeah, there's return on, okay, so here's return on investment. Okay, yep. Okay, so and once again, this is going to be, the formula is, nope, didn't mean to do that. Okay, the formula is the operating income divided by the sales. There it is. Okay, so we want that one to show. Okay, so that's the formula. Okay, so I got 7%. So for every dollar of sales we have, we're hanging on to 7 cents of every dollar. Oh, just a second. Oh, hold on.
I'm so sorry.
Oh, you're okay. It's okay. Let me just.
I left my keys at home. Can you unlock this door?
Certainly. Okay, we're going back to a profit margin, a percentage, an investment turnover, and a return on investment. So these two here, let me get my cursor where I should be. These two here are always quoted in percentages, and then this is just simply a number, and it represents how many times an investment has been turned over. So let's go to this next one. So investment turnover is sales right here divided by invested assets. So I've got 427,200. Wow, I've just found I want to make sure to put the right number in, and divided by 267,000. And it means that this invested has been turned over 1.6 times. So this is 1.6 times. The sales is 1.6 times the invested assets. Okay. And most people, well, investments happen to grow, right? To grow money, to get a return on the investment. All right, so mine is 1.6. So it was worth putting in all these three variables here. All right, and then the last one is return on investment. You simply multiply these two. So once you know the profit margin, once you know the investment turnover, you multiply them. So I multiplied 7% times 1.6, and I get 11.2, and that 11.20 is the return on investment, and we want it in as 2 decimal places for all of these. Okay, and the cool thing about this is once you put the formulas in, you know, I could come in here and put any amount of income or assets or sales, and then I would get what this comes out to be. Sometimes you're given the profit margin, and then you got to calculate this one, or you got to calculate the profit margin and they give you this one, or a combination of all of those. So once again, these are ways of analyzing. So I'm going to go out here. So once again, we're evaluating decentralized operations, but so this is an investment center. So one more time, the 3 kinds of centers that we can break up or decentralize businesses into are cost centers, profit centers, and then investment centers. Once you have investment centers, in fact, I'm going to put that right here. That's how you analyze an investment center, is through these. So let me put investment center. Okay, because I want to make sure we know what's going on. All right, investment center. An investment center includes costs and revenues, but also the assets invested. All right, so we can get return on investment, the ROI, and that's what we're finding here. And then we're going to do residual income. Okay, so now I think we're on to residual income. It says, because investment center managers have responsibility for revenues and expenses, operating income of investment center reporting is also part of their responsibility, because the manager has responsibility for the assets invested in the center. The following 2 additional measures of performance are used. So these are called performance measures. So up here doing these, it's a performance measure of the investment center. Okay. All right. Now let's take a look at, so this is a income statement of 3 different divisions. For example, their operating income. Okay. And we could do these measures for each one of these, because there's operating expenses, there's revenue. The only thing we didn't have in this list is your invested assets here, but you could probably come up with that. Okay, return on investment, ROI. Here comes residual income. Okay. Residual income is useful in overcoming some of the disadvantages of return on investment. So return on investment has its advantages and disadvantages. There's always something that lacks, usually of a measure, right? So oftentimes both are used. The return on investment and the residual income both get calculated to see what happens. Okay, so once again, residual income is the excess of operating income over a minimum acceptable operating income. So a business can decide what their minimum is. All right, so this is calculating residual income. You need operating income to get started. Then you're going to have some kind of a minimal accepted operating income as a percentage of the investments, okay, of investment assets. Okay, so let me get rid of this. Okay, and move it over. Okay, so the minimum, right? Okay, so we know what the operating income is. So then you take your invested assets times whatever percent return minimum they decide on. Okay, so it's not something you have to decide. Okay, this is the minimum accepted operating income. And they have to tell you what it is, and you have to multiply that times these assets to get the amount of your minimum accepted operating income. Okay, so we've got excess, right? So let me fix this now. Okay, so we want to subtract D. Okay, so D 125 and D 128. Okay. All right, so D 12, okay, D 125 minus, there we go. There we go. All right, so we have 86,940 residual income. Okay, so if you looked at a business here, we've got three divisions. There's their operating income. A minimum accepted operating income as a percent of invested assets. So it looks like this company believes 10% is that number. So while this one looks really good to begin with, when you calculate the minimum that this division has, look how much lower this one is. Okay, as far as residual income is concerned. So if you're looking at residual income as a performance measure, it turns out that the Northern Division is actually the most valuable when it comes to residual income. Okay, residual income. All right, so we can figure this out. All right, so back to the problem. Residual income. Let's make sure I've got all my numbers in. Okay, we've already put that in. I guess I hadn't checked it yet. Sorry about that. Okay, residual income. We have residual income of 120,380. We have invested assets and a minimum accepted return on investments of 11%. So when you do the math for the minimum, which is 11% of this invested assets, and then you subtract from operating income, our residual income, therefore, is 86,940. Okay, 86,940. All right, this last one is called transfer pricing. Okay, transfer pricing. So this has to do with usually a corporation or a big conglomerate may have businesses that can sell parts or part of a product or services or something. And because they're in the same business, there can be some negotiated pricing to where it doesn't cost as much for the one buying. But whenever there's transfer pricing, there's a buyer and a seller. Okay, and you kind of have to know which one's which, right? It's a buyer and a seller of product under same company. Okay, so, all right, there's something called the market price, right? The market price, that is the seller. Seller favors that. Okay. There's the cost price, which the buyer favors, right? However much the buyer can save on buyer favors. Okay. So somewhere in between is the negotiated price. And sometimes there's a negotiated volume as well. So I did put the three prices down: market price. Sometimes that's called fair market value. Okay, and transfer prices may be used for cost, profit, or investment centers. Okay, so here is a good picture. We're looking at a negotiated price. So the seller, right, knows what their costs are, and they would prefer to sell it at the market value. But a buyer knows what the market price is and would prefer to buy it at a lower value at cost, right? So here's an example of those three divisions again. Oh, two divisions and a total. Sorry about that. This is income statements without transfer pricing, right? So if you go through each one of these, the sales and that they're charging, how much they're charging. These are expenses. And then here is for the Eastern Division, 200,000, 100,000, 300,000. Now, if you look at negotiated transfer pricing, okay, so what's going on here is that using the market price approach, the transfer price is the price at which the product or service transferred could be sold to outside buyers. So there's reasons for transfer price of the market price, okay? For example, if the seller is at capacity, okay, if the seller is at capacity, they can already sell everything that they have at the market value, right? Okay, so if you're looking at the difference between these two income statements, you can see that we have an extra line of 20,000 units at $20. Okay, so there's the 20,000 units at 40, and there's a 20,000 unit at 15. There it is. That's the one that's extra. That's the transfer price. They agreed on a price of $15, okay, because it says here, but the Eastern Division is operating at full capacity of 50,000 units and can sell all it produces to either the Western Division or to outside buyers. So a transfer price of $20, if the seller is operating at capacity, then there's really no incentive for them to sell it for anything less than the market price itself, okay? All right, transfer pricing is used to charge for products or services between divisions, product divisions or services, because transfer pricing will affect a division's financial performance. Setting a transfer price is a sensitive matter for the managers of both the selling and the buying divisions. So once again, the selling division would like it to be sold for the most. The buying division would like to buy it or transfer it with the least, okay? So let's go to our problem, but I do want to show you that the only difference between these two income statements is this 20,000 units at 15. So it added 300,000 to Eastern, right? 300,000 to Eastern. And so the transfer pricing was $15 at 20,000. That's where they're getting their 300,000. And then the variable of 70,000 is 10. Okay, so 20,000 at cost. The Western Division. Okay, the Western Division is is the buyer and the eastern division is the seller. Okay, because you can see it being sold up here. I'm just trying to see here. And then it's an extra 20,000. So they didn't have 20,000 times 25. Okay, they ended up. So here's 90 and here's 80. Okay, and I'd have to look to see what the capacity is. All right, but anyway, so over here, those 20,000 that we agreed to transfer. Okay, okay, so because this division had more sales, right? It went from 200 to 300,000 as the operating income. And this one has, so 800 is the same on the sales, and then 600 and 100. So the extra 100,000 that's right here, okay, that actually went down. So, looks to me like, okay, and that's the variable expenses. So, and then fixed has stayed the same. So it's the units at $25 a unit that their costs went down. Okay, costs went down. If you look at 500 to 600, there is your operating income difference. So here they have an operating difference of 100,000. Here they have 100,000 and 200,000, right? Because each one of these has income going up, right? This was 200,000, now it's 300,000. 100,000, now it's 200,000. Now your company as a whole has gone up 200,000. Okay, so let's go to the problem now. All right, let's see what we've got. Just label what they say. Okay, transfer pricing, the market price is 82. The Harmony division, okay, the Harmony division is the seller. I'm sorry, is the buyer. They buy outside supplies. So let's read it. The materials used by Harmony division of Kirtland Company are currently purchased from outside suppliers. So here is the buyer. Okay, it's good to know which side of the transaction they each are on. Okay, and all right, and they buy at $82 a unit. Okay, it says these same materials are produced by the Nauvoo division. So our Nauvoo division is the seller. Okay, that could sell inside, right? And the selling division currently produces 130 units, but has a capacity of 160. Okay, so current production, and this is capacity. So the excess capacity is 30,000. So that's going to be helpful to bringing the transfer price down some. The two divisions have recently negotiated a transfer price of $72 for 15,000 units. So the cost was 65 per unit, and that's the one the buyer favors, okay, who's trying to buy these items. The seller favors the market price value. So this is in between, and here is the volume. All right, here is the volume. So if you took the volume of 15,000 times, okay, 15,000 times the market price is 1,230,000. Okay, 1,230,000. So if they could sell it for that, then that would be good. Okay, so then, oops. Okay, then the transfer price was decided at 72. So then okay, the transfer dollars is the transfer price times the transfer volume. Okay, so we want that there, and then if this is what it would cost us to buy outside, and this is what we could buy it within, here is how much would lower the cost. The cost would go down by $150,000, okay? So if you can reduce your costs, 150,000, right? Then it says, how much will each division's income increase as a result of this transfer? So, lowering a cost is one way of increasing income. Lower costs, increase income. Yep, there it is. Okay, now let's look at this one. The Nauvoo division is the seller. Once again, their current production is 130,000. Their capacity is 160,000. They do have excess capacity of 30,000. So we're going to be able to negotiate a better price. If they were at capacity, then we might not be able to, because they would rather sell it for the $82 price for help with their income. All right, but they have capacity, so it depends on. All right, so one more time. The two divisions have recently negotiated a transfer price of $72 for 15,000 units. Well, the 15,000 fits into the excess capacity. So does order fit into excess capacity? Question mark. Yes, it does, because it's 15,000, right? 15,000. I'll put fits in excess capacity. So that's another reason for doing more items. So if you're not running at capacity, here is a chance that if we accept this $72 negotiated price for half of our extra capacity, then we probably will bring in some extra revenue. All right. So what we're going to do is take that one more time, the 15,000 unit capacity, unit order. That's the order that Harmony needs to buy 15,000 of something that the Nauvoo division can supply. All right, so there's the transfer dollars right there. Here's the variable costs. So variable costs are $65 a unit. So variable costs, and I'll put per unit. Okay. Variable costs in total. Okay, so we want to subtract the transfer dollars that we would bring in by doing this 15,000. So the transfer price, just so you know, is $72. Put it in here. And the volume is 15,000. Yep. Okay, so once again, this transfer volume is this number here. Oh, and then, yeah, so let me move that. Hang on just a second. So you know that's what it is. Okay, this equals the agreed upon $72 negotiated price times 15,000 unit order. Okay, and we want this to show. So get rid of the equal sign. All right. So we want to see how that's calculated. So then this one is calculated based on that same volume, but the variable cost per unit. And they said it's $65. Okay, so variable cost per unit is 65. Okay, so then this is going to be the variable cost per unit times, okay, the transfer volume. Okay, so let me show this so that you can see it. So this is going to be $65 times 15,000. Okay. So that's what this is. 15,000 times 65. So this is their variable cost. So when you subtract the transfer dollars that's going to come in, right? That's the 72 times 15,000. Then we're going to send out 15,000 units that have a variable cost of 65. And so we're looking at increasing income for the seller. So let's do the seller here. It's 105,000. It's going to increase the income. And for the buyer, it's going to increase income because we're cutting the cost. Instead of paying 82, we're going to pay 72. Okay, and so it's going to, and I just want to make sure. So one more time, Harmony is the buyer and Nauvoo is the seller. So I think we're okay. All right, that's it for the intro exercises. I will have the coursework video up soon. Okay, so I'm saying goodbye for now. Keep up the hard work.